From the morning reading, the SPX breaks long-term resistance and makes new high close. Spiders, Diamonds, XLI, XLP, new high close. Alcoa earnings per share scores big after the close. All 9 sectors moved higher on Monday. XLI, XLK, and XLY were the strongest sectors, while XLP was the weakest sector. Oil futures fell 57 cents to close at 44.55. Breadth weakened compared to the prior day as advancers led 2064 to 946 on the New York Stock Exchange and led 1724 to 872 on the NASDAQ. Spider, or the SPX I should say, broke out of its long-term horizontal resistance and made a new all-time high close. Remember that breakouts typically test about 70% of the time, so a retracement back to the prior resistance would not be a bit surprising. In the S&P 500 snapshot, a record close on light volume. After a 286 market day pause, the S&P 500 finally closed at a new record high, finally topping its previous record close of May 21st of 2015. The index spent the day in a relatively narrow trading of 0.54% range, which is the 12th percentile of the 131 market days so far in 2016. It opened at its intraday low and stuttered to its 0.62% intraday high at the end of the noon hour. It then traded in a narrow range until the final hour, which ended with a trimmed gain of 0.34%. The yield of the 10-year note rose 6 basis points to close at 1.43%. Defensive sectors have led the rally. On Friday, we looked at times when the S&P went 50 or more weeks from its last 52-week high. During that time, utilities have led all sectors while financials lagged. Looking at 19 other long stretches between 52-week highs, there was not another time when we saw those two sectors lead and lag. Overall, though, it is not unusual to see more defensive sectors lead the market between new highs. The S&P cycled from a multi-month low to a one-year high and near record time. Going back to 1928, there are only 3 other time periods where it went from such a low to a high within a couple of weeks, and its performance over the next several months was ragged. Penny stock trading has fallen off the cliff. The NASDAQ has reported that penny stock volume for June was only 202 million shares, down from 4.3 billion in May, which is already extremely low. Dollar volume hit an all-time record low as well. As noted in prior reports, there's been a chill among brokers to allow trading in these stocks, and that has likely influenced the data to such a degree that it's no longer an accurate clue to sentiment. We're no longer considering it to be a positive sign of apathy among speculative traders due to what appears to be a secular shift in activity. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:06 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 12th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, so let's go ahead and dive into the morning report. And our activity in the overnight was fairly active, and we're up nicely on all 4 of the broad market U.S. indices. S&P futures are up about 10 points, or about 0.5% at the time of this cut. Russell futures up a little more than 0.5%, as is the NASDAQ. Dow futures are up a little less than 0.5%. Crude oil up sharply 2.84%. Euro up about 1/3%. Bonds down about 0.78%. And gold is down a little more than 0.5%. And overseas action also all positive in the markets that we follow. China up 1.82%, Hong Kong up 1.65%, Japan up about 2.5%, and Germany up about 1.5%. United Kingdom is positive, but just above scratch. In terms of macroeconomic reports of note for today in the United States, we have the JOLTS job openings and FOMC member Bullard speaking. And looking forward to tomorrow, we have crude oil inventories, the regular weekly report, import prices, and that looks to be about it of note. There are a couple other yellow flag reports during the market day. In terms of current volatility conditions, as you would expect when you're setting an all-time new 52-week high, an all-time high, you would expect volatility be coming down, and it is very low, though it didn't really come off very much. It seemed to kind of hold on, and we'll take a look at the VIX chart here in just a moment. The short-term VIX, though, 12.23 is certainly quite low. IV percentiles, very, very low. We're down to single digits on 3 of the 4. The S&P at a 6, the NASDAQ at a 7, the Dow at a 2, with the Russell, the one at a 13 in double digits still, but still exceptionally low. A standard deviation move was put in by the Russell yesterday. It was a positive 1 standard deviation move. The other 3 were mostly a gap up, and then it just kind of sat there. It didn't go terribly far. Let's go ahead and take a look at those charts. So let's go ahead and start with volatility. We've been talking about how volatility's got something of a, pretty extraordinary crush. I mean, you expect that when you get this signal for a vol spike and then the subsequent signal for firing off the vol crush, that it would come down pretty quick. But we went from a high of about 27-ish down to, we're approaching 13, below 13, and really just a few days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 10 days it took to really crush volatility by more than 50%. So that's a pretty extraordinary move there in that period of time. Now, obviously, we had a binary event that was part of what caused the spike. And then as soon as that binary event was known, it crushed pretty quickly. If you thought that people were fearful after the outcome of the Brexit vote, this should tell you that as soon as they were able to sort out what the implications were by company, by energy group, by sector, by industry group, it was easily digested and they moved on. So this is not a fear factor across the entire financial market, as perhaps some people might have suggested going into that vote. Here you see the VIX futures, and in the overnight action, we are again dropping. Let's go ahead and go to the S&P. And this is where we had that record activity. And so far today, we seem to be building on that. Yesterday, using the S&P futures chart, we had kind of a poke above and an intraday new all-time high, but a close that was about 4 points below the prior close of last May. Well, that so far seems to be getting resolved by the Globex action today is following through, and we're clearly up above that area now. So we'd love to get a sharp close well above this area and start to see some separation to really show that the bulls are in charge and that this is a new bull leg forming and not just a whipsaw kind of tease and then back into the prior range. That's the big danger right now. That's the million-dollar question. Is this just a tease and then back into the range in which we've spent the last over a year and a half, or is this something more? And we won't know that probably for a couple more days. Now here's the SPX, and of course this is cash only market, and this closed at an all-time high yesterday, as well as setting that Globex high of 2143. So that went some 9 points beyond the prior intraday high, and then also closed above that prior intraday high. So that was pretty significant there, a clear horizontal breakout. Now here's the spider, and of course the spider has a separate close, but you see a very similar action where you have a pretty clear horizontal breakout with the action yesterday. So the question is, again, will we start to move away, or will we fall back into the prior range? Let's go ahead and take a look at the other indices. Dow also clear horizontal breakout. NASDAQ, of course, has more catch up to do. We did get a diagonal breakout with the action. Remember, this candle here is the last night and this morning, so this is live right now with futures. But this is yesterday's breakout and then the follow through so far today. So while a lot of room to be made, it's got to go up to 47.39 and change to get to its prior high. So right now this is just frankly coming into this swing horizontal potential resistance. We'll see if it continues to motor on like the S&P and the Dow would appear to be doing. The Russell, very much like the NASDAQ, broken through diagonal resistance. So let's not minimize this. This is important, very important. And perhaps some people, being caught short, not expecting that the bulls would be able to actually get through these levels, and we might start to see some, the shorts getting closed out, run over, if this starts to gain any energy or momentum. Now, speaking of energy and momentum, the volume on this with respect to the S&P was pretty light yesterday. But that's often the way it is with bullish moves, in that it just kind of crawls up like going up the stairs, whereas we often see the big volume come when we get corrections and pullbacks and the like. So we would love for this to be on big volume. Thus far, we haven't seen that big volume. But the other thing we're going to be watching is, where is the sector rotation going? And if this is truly a broad-based bullish move, then we should start to see the stubs, those staples, transports, utilities, bonds, some rotation coming out of the more defensive areas and going into, places like the discretionary and the technology and these higher beta areas. So when we start to see those areas do breakouts, and we see, big moves here in technology, but not yet really, the kind of horizontal breakouts that we were talking about with the S&P. So this has been largely powered coming up to this point on the backs of the stub area, and we'll have to watch how this matures. Now, it's okay. And one of the morning authors mentioned that sometimes you do get these new all-time highs on the defensive sector backs, but we'd like to see some greater movement towards these high beta, high growth opportunity areas. In fact, if we take a look at the ETF or the IBD top 50, there's a lot of distance that's got to be made to get back to its 52-week high, which is up here at some 2640. And right now we're trading, at around 2260. So a lot of distance there for that growth-oriented ETF to get back to where it once was. If we take a look at the Dividend Aristocrats, well, here are your big cap, big, strong, powerful, well-run companies. The Dividend Aristocrats, a history of 25 years plus of increasing their dividends without fail. Some of the best run companies anywhere out there. And you look, they're making 52-week highs. Well, this is your more traditional, boring kind of company, in many people's minds. Well, this is dramatically outperforming those IBD top 50. So that's not usually the sign that we see of a healthy bull market, but we still have to respect the fact that it's still bullish, no matter whether the composition of this bull is perhaps typical or perhaps what we would like to see, it's still bullish. Let's take a look and see how we're getting in terms of confirmation. Now, we've been watching to see would crude oil, have this breakdown behind the ascending triangle and then break back up and return. And now, ideally, I would have seen this after 1 or 2 sessions. Right now, it seems like it's attempting to do that. We'll see where that goes and whether it just invalidates this activity of the last few days. But crude oil seemingly putting in a move and perhaps joining the equity market in a move up. In terms of gold, the other safe haven seems to be on something of a pullback. That would be generally supportive of the equity move up, and that people would come out of the more conservative areas such as safe haven status gold and move into equities. And then, of course, there are bonds, and bonds also seem to be pulling back. So this is starting to make a little more sense than perhaps it did in that post-Brexit period where we had gold up, bonds up, utilities up, and equities up. Some of those correlations not typical for a strong equity move that's going to be sustained. And here you see TLT, big move, and the overall trend still very strongly bullish, but perhaps starting to give a little bit of that back. Okay, let's go ahead and go to the daily report. And this is just about as strong as it can get. It's taken a little bit here to get rid of all the damage that had been done in prior weeks, but if we look across the top section where we have our important kind of market timing signals, first of all, our intermediate term phase opinion is a strongly bullish phase 2, the trend reversal, the break of diagonal resistance. Frankly, we've now broken horizontal resistance. But in the 3 market timing signals, the first one coming to us from IBD, a confirmed uptrend. So an outright buy signal there. GMI index, 6 out of 6, a buy signal in place since 7-1. Though I would say the more sensitive GMI 2 has fallen to a 2 out of 8. So that we get a breakout and then a little bit of a retracement at some point in the short term, would not be surprising. Also, in the 3rd market timing signal, just about gotten to that clean stack that we like to look for of all similar signals across all indices, across all time frames. So we're still sitting out here with these lone contrary bearish signals on the long term in each of these indices. And once we get that, then we'll likely start to see the ability of the market to put together long-running trend moves start to mature. Not quite there yet, but we're probably getting relatively close on those falling into line. In terms of position sizing opinions, both at 100% as you would expect. In terms of intermediate term market posture, severely strong bull in both the S&P and the Dow. Dow now up over 90. NASDAQ on the verge of going to that same group, right just below the 80 threshold to be called a severely strong bull. And then Russell certainly is making up some ground. It has been the laggard in all of this, but is had a standard deviation up move yesterday when the others did not. It certainly seems to be making up some ground. We have the strength of the trend is currently strong. Our hedge warning status is at a level 1. If we confirm with today's action in a follow-through day, I will likely drop this to 0+, which is a normal level with some elements of risk still in place. Though those levels of elevated risk are starting to become fewer and fewer, and we may actually see this go to level 0 for the first time in months if we get some follow-through action that comes for the next series of days. I'm pretty hesitant, pretty careful to go to full-out level 0. we'll probably get to level 0 plus with at least one more good strong day and drop that down. In terms of special opinions, everything's pretty much a-okay to initiate new positions. Certainly start to mix in more positions, start to mix in some more out of the money strikes, some more higher beta positions. You might want to, if you want to be a bit more defensive, use out of the money puts to set up the entries to those more aggressive positions, just in case this pulls back or comes back into the trading range. Not really expecting that we'll see, in quotes, a failure of this area in terms of that we would break down and go into a full-fledged correction anytime terribly soon, but we could certainly see a resumption back into the range and just back more of the same. So you want to be careful entering at these breakout levels. I'm a breakout trader. I like entering on strength. At the same time, there is that danger, especially when we've had such a historical level of resistance where we've failed many, many times at this area and gone back into the range. You'd like to see yourself put on some new positions, a few at a time, as you gain confidence that this is real. In terms of specific warnings, you see we have the volatility ratio warning has entered the extreme zone. So now we're looking for a firing signal for volatility to start to increase. That has not yet happened. Skew also just barely above 125. So in the volatility group, that's the only two areas of warning. In the trend-based group, there are no areas of warning, and indeed very strong bullish signals. We got the New York Stock Exchange new high, new low, 686 yesterday. In terms of our third group, the key intermarket risk aversion indicators, these continue to improve. We now have two that are still on the risk off status, but they're clearly rolling up, and three that have now gone risk on. So in terms of remaining warnings, really the most important are these last two intermarket risk aversion indicators, and I would also point to this up here where the decision point scoreboard still has these bearish signals in the long term. I'd like to see those turn green. We start to see those capitulate and turn to normal status, then this market will probably drop to this level 0 plus, or even potentially to a level 0 kind of normal status for the first time, as I said earlier, in months. In terms of current sentiment, stock short term, a little bit elevated. More elevated are the bonds and gold, though they seem so far today to be giving some of that up, so that may scrub some of that extreme sentiment off. You also do have a number of ETFs that are at very high sentiment, so watch for potential reversal patterns also there in your LQD, BND, TLT, all obviously related to the bond complex, and then also silver and orange juice. If you're in those markets, look for those potential reversal patterns. Also in our fear and greed index that we get from CNN's Money, where it's a compilation of sentiment, you notice we're now up into the extreme greed quartile. So that is something of a warning itself, though sentiment can be extreme for extended periods of time. Just because that's high is not a warning in itself. What you got to do now is take from that, raise your radar sensitivity, and watch for potential reversal patterns which could form when you're in these extreme areas. In terms of sector specific, it's just about a sea of green. Only transportation showing one neutral signal in the long term. In terms of percent change for yesterday, look at the bottom down here. Consumer staples, telecom, utilities, healthcare, the more defensive oriented, they were the least productive yesterday, though, it's not like they were, big time negative. They were just basically circling around scratch, whereas some of these more high beta areas were clearly the performers of the day. We have had, and I didn't mention this yesterday, we went pretty long, but I will mention quickly the relative rotation graph through the weekend. You see, some of these areas that have been most interesting. Telecom, you see utilities is starting to turn back up and head back towards that upper section. IYZ is telecom, FDN is internet, IYR, the REITs. These are the areas that have been, performing the best compared to their peers. But also note that this has been really ragged action. And this ragged action, is as we were fighting up against that area of resistance in recent weeks, these have been bouncing back and forth. So we'll have to see if we can get some additional clarity coming out of the markets if indeed this bull market leg starts to mature and starts to form something. We could start to see that some of these industry groups actually form real trends and maybe make a move that lasts more than a week or two, but that we actually get some real trending moves come out. We can only hope, and that's what we're watching for at this point. So, gone long once again. We're going to go ahead and wrap this thing up, and we'll get to the disclosures. Hit the pause button if you need more time to review the disclaimers. Also note at the bottom the hyperlink that takes you to the full set of disclosures. We'll see you back here for the next trading session for Wednesday with our next market preview from Falcon Global. In the meantime, manage that risk, be smart, good trading. We'll see you back here next session.